Okay, moving on to our next presenting company is Wesdome Gold Mines. They own and operate 2 high-grade gold mines in the Abitibi Gold Belt, including the Eagle River Mine in Ontario and the Kiena Mine in Quebec. In 2025, the company produced 186,000 ounces, as both mines averaged double-digit head grades for the year. 2026 is expected to be a pivotal year as the company invests for optimizing production as well as exploration. Joining us today and presenting on behalf of the company is President and CEO Anthea Bath.
Thank you, Andrew, and thank you to everybody for listening to us talk about Wesdome. I'm always getting extremely excited to speak about this company, especially as we embark on quite an exciting year ahead. I think for those of you who aren't familiar with Wesdome, it's important to note what we are a little bit. We've been in production for decades, producing over 4 million ounces, and this company has had a very special record of converting discoveries into great ounces. When I think about an investment thesis for a gold mining investor, Wesdome ticks many, many boxes. The most important one, we operate 2 high-grade mines in Canada. Both our mines are highly profitable ounces. We produce about 200,000 ounces per year with a plan to grow that. We have a company that's got a quality, debt-free balance sheet. We generate significant free cash flow. I think what's really important for me is that our return on capital employed is also one of the highest in the industry, estimated to be 3rd in the industry in 2024. I always look at mines from the past and I say, how does it predict the future? And if I look at the future for Wesdome, I think it's quite bright, and hopefully I can give you a bit of a shaping of that as we go forward. We have 2 mines, as Andrew mentioned, in Canada on 2 of the best greenstone belts. One is lying in the Abitibi region, and the other one is lying up in northern Ontario on the Mitsubishi Greenstone Belt. For us that know these mining belts, we know that they've produced over 300 million ounces over their time, and nothing is telling us that these belts are stopping. In fact, there's multiple mine builds going on and multiple extensions, as you are aware, in both of these areas. And Wesdome has 2 beautiful packages right in the heart of these particular areas, which are largely underexplored. In 2025, our Eagle River Mine was the highest grade gold mine in Canada. We had a reserve grade of around 14 grams a ton. Our Kiena Mine was around 10 grams a ton at about number 4 in Canada. Just telling you about the quality of this mining company that we actually are. But I think when you look at what's overlooked by investors, and another reason which sets Wesdome apart from others, is the fact that we have a very material organic growth strategy with a very limited capital requirement to actually execute on it. We aren't just sitting on really good land, but we also have the infrastructure to scale this land. We have excess measurable capacity in both of our mills, which has been largely underutilized. When you look at adding an additional ton incrementally into these mills, it really is done at good profitable levels. We have an exploration program that we've really spent a lot of time working on, which is fully funded, and it's intended to really step out from what Wesdome has done before, which was largely more insular focused. And that is really where the real upside for this company is. It's really lying in discoveries. And if you look at the current pipeline of discovery potential in Wesdome, it's extremely significant. So what has changed in the last few years? Well, for years, Wesdome was really just focused on the year ahead. We were worried about just replacing our current resources, and we really were limited by the balance sheet to look from a growth perspective. This short-term thinking has really been evolved over the last while into really understanding how we can take the opportunity out of these very exciting areas that we actually own. It's a vision driven by value, and it's a vision driven by understanding and unlocking potential of the land. In Wesdome, we've done quite a few things in the last 3 years. We've changed our leadership structures and really enhanced leadership. We really focused on safety on both of our operations in a very significant way. And we also wanted to make sure that the infrastructure to scale was starting to be thought through and understood. The results are starting to show, and I'm pleased to say that in 2025, we did a couple of things which I'm very proud of, telling me that the core of this work is starting to make sense. Firstly, this company had record production last year, and associated with record production, we also had record financial performance. We also had 0 recordable incidents, and our total recordable incident frequency rate reduced to a third of what it was some 3 years earlier. Our cash position has nearly tripled, which is quite exciting, but I suppose we knew that that was going to happen. And at the same time, we prepared the company from a balance sheet perspective to be very strong, with over $700 million of good liquidity, which we can use to really drive this engine. But I think if you really want to look at what has changed in Wesdome, you need to have a look at the exploration strategy and how we evolved our thinking and what this actually means. Essentially, the idea here is not to replace reserves anymore. The idea here is to grow Wesdome, and it's to grow meaningfully into good areas. And what we've done is we've actually worked on a very systematic exploration program and doing about 270 kilometers of drilling this year, which hopefully will showcase this potential. But what's exciting is really the opportunity ahead of us is now really what we know this company is known for, which is discoveries. And we're looking forward to showcasing what we're seeing here. If you talk about the organic growth strategy, it's really quite exciting and very simple, actually. It's really about filling our mills and extending our mine life, and doing this at typically the same or equivalent grades to what we've actually been running these mines at. Just for context, this mine really has been evaluated on a 3 to 5 year mine life over its entire life for the last 30 years. And in such a way, people have almost valued this company on that basis. We also have 2 mills that essentially have operated between 30 and 60% of their available capacity. And this is purely because of the way these mines were structured some many years before with a different mine profile. We now have a very clear and distinct and measurable roadmap that we're using to actually unlock this particular value. And it's an organic strategy driven by 3 pillars, 2 of which are production focused and 1 of which is actually cost focused. And we're doing this with a supportive balance sheet and with a supportive team to do it. The first pillar we spoke about is really our exploration pillar, which is the heart of Wesdome. And for those of you, I've said it a few times, it's been the reason why Wesdome has been so successful over all these years. And it will continue to be the highest return on value. And I think this graph over here shows you how we're thinking about this. You can imagine the sheer scale of the opportunity at Wesdome. We have 400 square kilometers at Eagle River. We have 75 square kilometers in Kenya, surrounded by the majors, as most of you know. But we really have largely underexplored these assets. These assets have focused mostly on near infrastructure drilling and not really on step out or any other drilling. Over the last 2 years, our team has really stood back from this. We took a look at what's been done historically. We mapped every single drill hole that was drilled, and we put it into a database to try and understand potential opportunities across these properties. And that's what you see in front of you here. We have 250 different opportunities, which are real opportunities that we're following up on. The exploration team has gone through that. They've prioritized them. They've understood the materiality of them. And they've also understood the ability to get these into the mill and to add good value. And with that, started the journey of executing on a systematic approach towards exploration. We started the first year of this last year, which was a 200-kilometer program, which we'll start to showcase this year. And obviously the next year, I already mentioned, is a 270-kilometer program, which will continue. And we have the next year in planning already. I mean, each of these drill potentials are not something that's a hypothetical idea. These are following up on a drill hole, they're following information, and they've been evaluated with an ounce profile attached to them, as well as a drilling profile attached to them. Discovery cost is what we care about. Return on capital employed is what we care about. In 2026, I'm hoping to show how this starts to unravel a bit more, because the first year is starting to power through. And when you look at this graph, you're wanting to qualify all of these different resources up to make them more real into your mills. For those of you who probably know the company as well, you'd know that Wesdome's hit rate has been between 80 and 90% on drilling. If that is true for what we're seeing here, you're probably going to be as excited as I am about these properties, because I get to see some of the early results, and it's truly exciting. The second pillar we speak about is quite unique, and it really focuses on more the engineering style and more the asset optimization angle. What we did 2 years ago is we decided to digitize decades of many millions of meters of drilling, as well as many meters of development in this particular mine, to try and understand this mine a little bit better. And the process of this was really to get a sense of the true system. If you have a look at what you see in this picture here, you'll see The long section of Eagle River Mine is about 2.5 kilometers. It goes about 1.2 kilometers deep, and its width is about 800 meters. So when you look at these ore bodies, they look flat, but actually they're lying parallel to one another. In doing this work, we really applied a very simple logic. We're going to keep the cut-off grades the same, and we're going to keep the mine parameters in this mine the same, and we're going to try and understand where material potentially was left behind or not understood, or if there's other opportunities. And in this process, we were able to identify around about 50 different targets for us to follow up on. Now, these are not targets that are in any resource right now. These are targets that merely we understand to be there in some other form. The team prioritized these targets, and over the last 6 months have been drilling out a 40-kilometer plan to understand these and convert these into incremental tons that can come into the mill. What's exciting about this particular program is the fact that this incremental ore, or ore that's available, which is at good value, is very close to existing infrastructure. And the idea of this is really to add this and incrementally fill up the Eagle River Mill at the same time. In June, we will release a statement on this, an updated mineral reserve statement. And I think you'll be pleasantly surprised, I hope, when you see this, because when we put this together with the exploration work we're doing, it might give you a bit of a view into how interesting Eagle River's long life is compared to what people understand it to be. When you look at the third pillar, it's a simple one. This is about cost controls and cost optimization. And I think lowering cost is fundamental to myself and my team. We care about this. It's important. For us, margin resilience and margin growth is really important. Even though we're sitting at $1,500 to $1,600, we sit somewhere in the middle of the cost curve. Our idea is to get this lower. For us, making sure we keep margin resilience is critical. Making sure we understand the opportunities to optimize is critical. And there's a lot of work going on here. And we've already seen some of these results come through, whether this be in supply chain, whether this be in some of the automation work we're doing, some of the maintenance, which seems to be a large portion of our costs. This is all going to result in productivity and improvements in terms of our cost per ounce. Just to put into context, when you look at the levers I've spoken about, if we're able to add 10,000 incremental ounces at $5,000 gold, we have a free cash flow on the back of the envelope of about 35 to 55%. We're looking at a $15 to $30 million additional free cash flow that we can generate just by doing this kind of work. But what is the vision? What is the vision for this company? Well, ultimately the vision is to grow Wesdome into a mid-tier mining company. We'd like to see ourselves a 400,000, 500,000 ounce producer. And I think when you look at this slide, it gives you a bit of a glimpse into how we see this. Some of this lies obviously in filling our mills using existing capacity, and you can see the ore bodies that are there to do so. But obviously at a regional level, you can just imagine we are obviously finding things too, which gives us the next phase of growth to grow Wesdome a bit further than that. We have a very good pipeline of both underground opportunities, surface opportunities, bulk opportunities, open pit opportunities across these properties. When you look at the scale of them, you can imagine that they must be quite exciting. We wouldn't be drilling them if we weren't. This insight will be announced during our technical review again, as I mentioned. But exploration and other growth opportunities will remain obviously important, but also scale matters. So Wesdome does care as well about acquisition. Wesdome does care about inorganic growth. It's part of what we want to do. We've obviously been looking at various acquisition targets, and we keep very prudent on these things. But we haven't made one yet, but we do look, as you probably all know. I think we're pretty disciplined in the way we think about this. I think for Wesdome, we're really now wanting to focus some more on finding high-quality development and high-quality producing assets if they're available, the right fundamental principles from a value perspective. When we look at acquisition as well, it's all about how we strengthen our investment case, how it fits into the profile of Wesdome, and that's quite fundamental to us. Wesdome's really built a strong reputation of consistently delivering on shareholder value. It's not just in absolute terms, it's actually been on a per-share basis. And if you look at this particular graph, which is the 10-year profile of Wesdome, it gives you a bit of an insight. On a production per share and operational cash flow per share, we've actually increased quite substantially. And similarly, at the same time, we've been able to increase our reserves and our resources during an area of growth. These increases per share are really driven by two main factors. The one really around making sure we have a very strong approach to minimal dilution of our shareholders. And secondly, we care about fundamental performance that translates into industry-leading return on capital employed. This reflects in the inherent value of these two assets. If you look at this in inherent value, you can look at these slides, which give you a sense of how Wesdome compared to its peers as well as its senior producers. And on metrics that matter, Wesdome doesn't just outperform its peers, it's outperforming the seniors in some cases as well, which is what makes it so incredibly special. We're taking a very considered approach towards capital allocation at Wesdome. We balance what we require from an internal organic growth perspective with giving back to our shareholders while maintaining financial flexibility that we'd like to see. Last year in the fall, we implemented a share buyback program, which we started to opportunistically buy on. But when it comes to obviously the generation of capital, Wesdome produced $250 million of free cash last year, and at our internal assumptions below $4,000 gold, we are looking at doing another $350 million. You can just imagine that this is going to grow. And at the same time, we'll keep reviewing these capital allocation frameworks to make sure that they're appropriate for the time at Wesdome. 2026 will be an extremely exciting year for Wesdome, and it's one that I'm hoping people will see the meaningful work we've done, the amount of effort we've looked at in really shaping Wesdome and setting it up for success. We've spent a considerable amount of time looking at how to optimize value from the asset, how to reshape the team to look in a more value-based way. And we're hoping that this year you'll be able to see some of the fruits of that come through in a more significant way. Some of the catalysts that matter to us that you'll hear about, and there'll be probably a couple more as we go through it, but we'll bring out these technical reports in summer, and we'll put out a statement in June, which will not only indicate the particular mineral resource reserve statements, what it also should tell us a little bit about is what that growth potential is. So we'll be linking in the resource or the exploration strategy together with the strategy to showcase how these assets start to unfold relative to some good data that will support that. You can obviously also expect that we're going to do, with all the exploration we've got, a number of exploration releases over the time as well. I think that will give you a sense of some of the messages that should be showcased in the story in a more significant way. And we'll try and again align them so you can see how it starts to showcase the story. And I think at the same time, we'll remain very disciplined on our capital allocation. And we'll keep reviewing capital allocation correctly as we're going forward, as the story unfolds, and opportunistically buy back on our shares as well. At the core, my entire team's focus is very, very clear. We'll continue to drive value by growing this company in a very disciplined way. We want to keep looking at margin expansion because we do believe that's where value should be and resilience matters. And we'll keep making discoveries and converting these into answers that generate good value back for our shareholders. We will make sure that when we look at these land packages, we're caring about them in a way that really gets the most out of them, because they are honestly precious. And I've worked in the mining industry for quite some time right now, and I always say to people, I was given an opportunity to look at some extremely high quality land, and I almost feel like I've been gifted with a company that's ready to really grow within this, and it really is as special as that. I hope that we can share that excitement with you as we're going forward, but similarly, also showcase through the results that we do how this company is far bigger than what people realize. Thank you very much.
Okay, we've got a couple of minutes for questions. Happy to take questions through the app, or if so inclined, we have questions in the room. A microphone's coming to you, Ranjan.
And you mentioned a goal of 450 to 500,000 ounces in the intermediate term. Would you define intermediate term? Would that be 2030, and how much would be organic internal growth and how much through acquisitions?
Yeah, that's a great question, Rajan. Maybe we should go back to the slide quickly, if you can, Trish. If you look at the internal inherent capacity in Wesdome, we have about 50% on average mill capacity within the operation. And you heard me talk about all these 250 different targets that are out there. Each of those targets have got an ounce profile as well as a drilling program attached to them. So you can only assume that we're going to look at filling up our mill to some degree. And that tells me, I always say to the team, there's a mine within your mine. That's the first thing you should be looking at if you've got such capacity and such asset. But then on top of that, if you look at the region itself, we're getting quite excited because what we're seeing across the region is other opportunities that are starting to unravel. Some open pitable things, some things that are bulk tonnage, which are different from what we saw before. We're respecting those ore bodies and starting to build them out correctly. So we could very well see the next layer growing there, Rajan. And then the question is, what is the difference would probably be whatever that might look at beyond that. So it's difficult to pinpoint exactly what the balance is between the two. And it also depends on the timeline that we're looking at too. But you can imagine that the focus is, okay, if you're worrying about return, let's do it step by step. That's not going to go away. We're going to balance both.
Any other questions from the audience? I'd like to extend that question a little bit, and I know part of the answer is going to be wait for the mid-year resource global model discussion, but maybe is there 2 or 3 zones that you would consider, you could give us some teasers as the people should be watching for having a starring role in this upcoming mid-year?
Yeah, I think if you look at, it's interesting because we're doing very systematic drilling, so each of the areas are starting to come through and starting to showcase in that triangle in some other way. So if you look at Eagle River itself, the Eagle River current mine, if you saw the global model work we're doing, should give you an idea of some tons. What are the tons and how do we extend with the tons? And remember, those tons are at the same cut-off grade, so it's really important to understand that the same value. So I think you'll see that part there. What you'll also see then is probably some regional stuff really starting to pop out. The Mishi Magna Khan area being quite interesting. In Kenya, there's just so many opportunities that are starting to unravel as we speak. You've got the Kenya Deeps area, you've got the footwall zone that's growing, you've got Dubuisson that's growing, you've got 134, you've got Northwest. All these areas are starting to come together.
Okay. Maybe that's not a bad segue to Kenya Deeps. I think objectively, some of the expected performance from Kenya Deeps from previous years hasn't yet materialized. Maybe, I know you answered part of this question already, but maybe you could just give us a sense of what hasn't worked yet and what kind of trajectory to recoup some of that could be from Kenya Deeps, which drives a significant portion of the value of the Quebec mine.
Yeah, I mean, absolutely. We were equally disappointed with Kenya Deeps as well in our performance. And I think mining from a single area was one of those reasons, and getting our operational flexibility better was needed to do that. I think 2026 will be a better year. We're now in 3 areas. We're now unlocking, we're going to the second layer of the work that we need to do, which is around people, procedures, and practice, and making sure we get those systems right. We've thrown a lot at this problem at the moment to make sure we become more systematic in execution, and I think you should see those results coming through.
Okay, unless there's one last question from the audience, we will wrap it up. Thank you very much, Anthea.
Thank you so much.